Hi, good morning. It's 30th of October. So just today's volatility crude oil run through. I'm also going to have a quick look at S&P 500 vol strategy as well. So I'm trying to keep today pretty short because markets are busy. Everyone's got plenty to do. So if we have a quick look at crude over the last few days, there's been a small uptick in volatility. You can see here from Friday's close. We've got, just so you know, each month there's got the December, January, and March up here. You can see obviously as prices falling up, you tend to find the front month just has a tick up in volatility. There wasn't really much going on. Vol comes off, and then the sell-off in the equity markets and the indices pushed us significantly, higher from circa 26%. I think it's a 27.5% I saw. But the balance of the months didn't really change too much. So it's actually been quite a stable picture. Whilst crude's been kind of chucking around a range between 60, 68.5, 66, volatility's remained fairly stable to say the least. A slightly interesting pattern on the risk reversal though was just showing here that that sell-off in the underlying price just caused a couple of the months just to dip. They've slowly been recovering their put side bias. So you can see here as low as 0.3.5%. I think I mentioned in a video a few days ago, just in that 3.5% area, and we've slowly crawled our way back up to 2.5%. But there was a significant move in the risk reversal towards the end of the month. Sorry, towards the end of the day yesterday, and that was just following equities. So I've just jumped over to ES, so S&P 500 futures. The main quarter contract's got 52 days left here. The reason I brought this up is obviously everyone's kind of squarely focused on indices at the moment, and I just wanted to kind of show where we're up to, what's going on from a volatility perspective. You can see here this red line was the beginning of October, what the ES skew looked like, and if we just move off this constant maturity here, get rid of that and get rid of that. Sorry, let's wait for this to reload. Here we go. You can see the objective of the skew is to predict where volatility would be as we travel along that path. What I mean by when prices were, say, here in this upper 29 area for the underlying, what the skew would represent is as we raced further down, we should follow that path. So this midpoint here, which is, I'll show you on a different picture in a second, that we should follow the midpoint, should rise. And you can see we're here now, and you could argue that at the period of time of the 3rd of October, it was basically stipulating that we'd be here. So there's a value opportunity that there's actually, we are slightly, the midpoint has the entire vol path has lifted by a percentage point or two. So, and that if I move, so you can see here, this is the live price of ES. If I move this out, you can see the green dots are live bids and offers. The orange dots are their settlement, and so if I put my points in here, so the dots you see here are the price that I would be quoting to the market, and we can turn that off because sometimes it just creates a little bit of clutter on the chart. So the key is that the white line is what I am saying is my theoretical price. And one of the things that I've noticed is that while we have got this significant leap here, as you know, the at the money has moved from circa here, the belly, as we've travelled all the way down. We're actually a significant leap higher, and I feel at this stage that we're probably slightly overdone and looking for a strategy that would enable that to come back into line. So what I've got here is I've actually done the previous view that you could see with just the skews, but done it by delta just to really articulate the jumps that we've had. So let's just focus on the 30 deltas just for a second, and you can see that really we've come up from kind of 12% to 21% 30 delta on the put side, and on the call side that's 8.9% up to 17%. So kind of if you were to sell a strangle, you get an average of around 20% by selling, the 30 here and the 30 here. Now, why we've chosen the 30 is if you start doing anything less, you're going to be kind of a bit wingy here. Is that these any more big snaps down in the indices could cause these wings to exacerbate their move, and also you're going to find that they flatten off here even more, so you're not going to get that short side benefit over here. So it's kind of an optimal space for the ES. Crude's optimal space for this is between 20 and 25 delta, but it's a safer place to play, and you don't, for this particular thing, you want to avoid kurtosis. So your kurtosis is the steepening of the curve. So if you imagine a kind of a flat curve with minimal kurtosis as a dinner plate, right the way up to the extreme form of a champagne glass, nearly a V. So we don't want too much kurtosis risk around the trade. So. And then if we jump to, you can see, it's quite interesting to see here is that we've got a significant steepening of the curve here. So you're actually going to be, that what was articulated in that previous picture was it done by delta. This is just done by strike. And if we highlight where the out the money is here. So we're steeping off quite dramatically, and 30 deltas around here, and 30 delta be around here as well. And let's just check to see what the changes did. So volatility's come off today, but not in the wing, in the put wing. Do you see? It's very tight around here, and it's just lots more aggressive selling in the belly of the skew. So, okay. So what I've done here is I've actually just put on a trade just to show how we'd attack that 30 delta space. So you can see just 3 lots. Sold a 30 delta 25-35 strikes, and the opposing side on the call side a 30 delta 27-40, and that should have given us here you go a short strangle position, just 3 lots, but what I wanted to do was try and achieve a short Vega position of $1,000 per percent of volatility, just to articulate how this works and what needs to happen. You can see it's fairly low hedging cost. We don't even need to hedge a 1 lot unless we see a 3.5% rise in the equities, or a nearly 4% fall on the equity side. But that was selling volatility at circa 20%. And I think that based on the overreactions of yesterday, people will be paying up fearful. So we should start to see that the Vega curve is in our favour. So in an extreme step move, I won't go into too much details around the movement of this, but a step move down is vast numbers of profit for such a small trade, and it's the same, a massive rise up in volatility, but you wouldn't have a rise in volatility and a 4% move up. It just, equities don't move that way. Though you'd find that Vega would fall. So, and this is also showing a shock move, but I'll talk about how these shocks work later. The key is that we're trying to keep a minimal amount of hedging, but look for a fall in Vega. We don't want to be holding the trade more than a week or so. It's paying us $200 a day just to be short, but we'll see what happens. Again, just to prove the trade was real, it's here in the log. So it was done in 3 one-lot tickets at 80, 80 a quarter, 18 and a half, 23 35 strike, 27 40 strikes, 30 delta each. And it looks like overnight, since coming back, that we've had a small fall in Vega, which has just created a profit. But the objective of this kind of test trade to show everybody is we should be targeting the move back. Certainly, here looks a long way away with what's going on, but certainly we're overpriced at the moment around those 30s. So to be taking 3% out of that is an achievable place. So where's that? That's 15.9% against the 20 that we've done. I would say somewhere between 16.5%, 17.5%, which would capture $3,500 for fairly minimal upside risk. It's fairly minimal downside risk, but or upside volatility. Okay, that's it for today. I hope it helps.